It's John Crypto here. 3,100,000 ounces, priced at $78 for each ounce. Approximately $240 million utilized precisely when silver futures bottomed out on the CME group. Now hold on. That wasn't some casual speculation. It wasn't regular people acquiring coins from a website. That was a major transaction on COMEX, the arena where digital silver trades at a 100-to-1 ratio versus actual metal. And here's the interesting part. Following that published transaction of 3.1 million ounces, silver didn't just gradually increase, it took off. Sharp upward movement. Momentum started. Structure broke out. That specific price point where it had previously been declining, that $78 region, it turned into the starting point. Such timing suggests intention. Now consider the official explanation. They'll suggest it was due to consumer excitement. They'll claim it's because of demand to hedge against inflation. They'll emphasize ETF involvement as if it's just everyday investors spontaneously taking interest in precious metals. However, they conveniently ignore the delivery confirmations. They overlook the vault information. They overlook the reality that someone didn't simply trade silver, they obtained it. Now let's connect the pieces. The price was systematically lowered to $78. Every recovery was sold off. Every rise was limited. Unsteady investors were removed. Stop losses were activated. Margin calls happened. And while the price was decreasing, the level of open interest remained significant. That's not actual selling. That's digital pressure. Significant open interest along with a decreasing price is a warning. It strongly suggests a derivative attack. It strongly suggests a planned liquidity flush. In straightforward terms, here's what occurred. Sellers accumulate positions. Digital contracts overwhelm the market. Price falls. Everyday investors panic. Unsteady long holders liquidate. And someone is prepared, taking it all in. 3,100,000 ounces isn't accidentally taken in by coincidence. That's a predator's maneuver. Let's now examine volume. COMEX futures volume increased greatly during the flush. Substantial trading activity occurred as the price declined. Retail traders often mistake this type of spike as evidence of a trend. However, a change occurred. Following the delivery, the price increased rapidly. That's typical accumulation behavior. Restrain, acquire, then unleash. Retail traders follow green candles. Informed investors purchase during moments of panic. And securing 3.1 million ounces isn't a quick speculative trade. That's 620 futures contracts worth of metal priced per 100,000 ounces, multiplied significantly. That's deliberate positioning. Here's where things become increasingly intriguing. While futures were being acquired, the iShares Silver Trust, with the stock ticker SLV, displayed volume spikes. However, ETF movements lagged behind the futures move. Put simply, the actual acquisition occurred first. The ETF narrative came afterwards. ETFs are digital representations. They provide exposure. They don't provide control. COMEX delivery provides control, and control is important when supplies are limited. Let's now examine what is never clarified on TV: registered versus eligible. Registered silver on COMEX is available for delivery. It's available for settlement. Eligible silver. It's stored in vaults but belongs to someone. It's not automatically up for sale, and the levels of registered inventories have generally been reducing. So when someone acquires 3.1 million ounces, that immediately reduces the available supply. It's similar to depleting oxygen from a room that's already low on it. Now consider the important question. Why take delivery? Why not just extend the contract? Because extending keeps you in the digital realm. Taking delivery removes metal from the fractional system. It conveys, I don't trust the exchange. I want the assets with me. That's not hedging. That's accumulation. Let's take a wider view. We've observed this pattern before. In 2008, silver crashed to approximately $9 before soaring above $40 in subsequent years. In 2020, silver was driven down below $12 during the liquidity crisis, subsequently exploding past $29 within months. Each instance follows the same pattern. First, digital panic. Second, physical accumulation. Third, price discovery. And currently, we just saw a $240 million physical acquisition precisely at the lowest point of a technical decline. You're led to think that it's a coincidence. You're led to think that the subsequent breakout was random. However, here's what they don't want you to observe: the COMEX vault system itself. Because believing this was a fortunate trade, wait until you observe developments within the registered inventories and how swiftly the available physical supply is diminishing. Because when the warehouse reports from COMEX are examined, the situation becomes clearer. Inventory levels have been decreasing, gradually rather than rapidly, but continuously declining, ounce by ounce, month by month. Now here's where it becomes risky: registered silver, the only category that is officially deliverable against futures contracts, has been tightening, while open interest remains significant. Consider that. The quantity of digital claims remains elevated, while the quantity of metal available to fulfill those claims decreases. This means digital claims per ounce are increasing. This means leverage is increasing. This means vulnerability is building. Here's the crucial point. People frequently use the term inventory as if it's consistent. That's incorrect. Registered metal is deliverable. Privately held eligible metal is stored in vaults, but it's not automatically available for purchase. Eligible doesn't equate to available. Therefore, when total inventory figures are mentioned on financial TV, remember they're combining categories to make the vaults appear more stock than reality. Now consider the ratio. Each silver futures contract represents 5,000 ounces. When open interest reaches hundreds of thousands of contracts, that involves potentially billions of ounces in digital exposure against a registered reserve that represents a fraction of that. This is a derivative exchange built upon a limited physical supply, and exchanges function until too many customers request assets at the payout window. That's the leverage vulnerability. The volume of silver on paper overshadows that of the actual metal by a wide margin. The framework endures due to the prevalence of cash settlements among traders, who typically opt out of taking delivery. But what happens the moment someone requests it, when a party seeks 3.1 million ounces? That generates stress. That's like air being sucked from the atmosphere. Now let's delve into the story's antagonist, JP Morgan Chase, a long-standing giant in silver clearing, deeply embedded within the bullion banking system, and proficient in both futures and physical transactions. Here's the recurring theme: depress the price during periods of weakness, fostering panic, enticing short positions, and leading to retail surrender. Subsequently, amass physical metal when the price is low, and when a short squeeze arises, they reap rewards from both angles. This isn't mere conjecture, it's an inherent part of the structure. Here's the manipulative scheme in action. First, aggressively sell paper contracts to drive down the price. Second, trigger margin alerts and stop-loss orders. Third, procure physical metal at a reduced rate through delivery. It's precise, and we've witnessed this scenario before. Back in 2008, the financial crisis sent silver plummeting to approximately $9 per ounce. Panic selling of paper permeated everything, leading to margin calls across diverse commodities. Yet, in the years that followed, it tripled, surging past $40. In 2020, during the liquidity crunch, silver dipped below $12, appearing lifeless. However, within months, it soared above $29. Each time, the same sequence unfolds. First, paper-driven panic. Second, physical accumulation. Third, price discovery at a later stage. And during these windows of panic, the bullion banks weren't lamenting on television. They were strategically positioning themselves. Now here's where individual investors lose focus. The iShares Silver Trust. Possessing SLV shares exposes you to price fluctuations in silver. However, unless you're a designated participant with substantial capital, you're not obtaining metal. You're simply holding a claim on a framework. Meanwhile, the true action unfolds in the vault. Withdrawals of physical metal, tightening of registered holdings, and a growing pile of delivery notices. That's the telltale sign. Now broaden your perspective. Industrial demand is not contracting. The production of solar panels consumes vast quantities of silver annually. The growth of electric vehicles intensifies the demand. Electronics, semiconductors, medical applications all depend on silver. What about mine supply? It doesn't expand instantly. Launching new initiatives requires years due to permitting setbacks, political uncertainties, and financing hurdles. Therefore, as physical scarcity intensifies alongside rising industrial demand, each large delivery event gains significance. This explains why 3.1 million ounces is more than just news. It's a litmus test. Because if an increasing number of major players choose to take delivery instead of extending paper agreements, registered inventories could dwindle rapidly. And that's when volatility doesn't just increase, it explodes. Short sellers panic, spreads widen, premiums diverge from spot prices, the paper structure begins to falter. But here's where the narrative intensifies. While the West engages in derivative trading on COMEX, the East might be depleting the available physical supply altogether. Depleting the available physical supply altogether. Pay close attention here. When silver trades at a higher price in Shanghai compared to New York, that's not a coincidence. That's a warning sign. When the price on the Shanghai exchange surpasses the price on COMEX, it indicates that physical demand is more robust in the East than what paper pricing in the West suggests. And here's the crucial point. Premiums incentivize action. If Shanghai offers a higher price per ounce than New York, traders don't simply analyze macro theories. They mobilize metal. Arbitrage commences. Physical silver departs from London vaults, COMEX warehouses, and is transported eastward where the premium validates the logistics. And what becomes of Western inventories? They shrink, gradually at first, then noticeably. Now, connect the links. Derivative instruments such as futures contracts, leveraged positions, and synthetic claims dominate Western markets. Eastern markets, on the other hand, depend more on physical settlement. This distinction carries weight because when arbitrage continuously directs metal eastward, the West is left with paper promises stacked upon diminishing vaults. Here's the unsettling question. Who is the buyer? Are central banks quietly rebalancing reserves? Are sovereign wealth funds protecting against currency fluctuations? Are state-backed industrial giants guaranteeing the availability of vital sector supplies? You won't receive a formal announcement. You'll encounter only silence. But you'll observe the consequences in the activity. Now broaden your focus to global politics, sanctions, trade conflicts, and the use of currencies as strategic tools. When the dollar transforms into an instrument of foreign policy, nations seek out neutral assets for transactions. Gold has historically served this purpose. However, silver is smaller, more prone to price swings, and more easily accessible and amassed discreetly. In unpredictable environments, precious metals regain their significance as currency. And this alters behavior. Here's where the situation intensifies. Industrial demand remains strong. The expansion of solar panel production uses hundreds of millions of ounces annually. Each new large-scale solar project requires silver paste to conduct electricity. The rise of electric vehicle manufacturing introduces another factor, encompassing battery systems, power electronics, and charging stations. From electronics and AI hardware to defense technology, silver is ubiquitous. What about mine supply? It doesn't double instantly to accommodate demand spikes. Establishing new mines takes 7 to 10 years from the initial discovery to actual production, complicated by ecological approvals, financial limitations, and geopolitical threats. Supply remains inflexible. Demand continues to grow. This imbalance creates structural tension. Now consider the consequences of weaponizing the dollar. If countries perceive financial instability, whether through sanctions, inflation, or economic pressures, they turn to tangible assets. Silver and gold become unbiased, universal, and independent of any government. They involve no counterparty. That's significant. And here's what no one openly acknowledges. If gold becomes too costly for widespread accumulation, silver becomes the substitute monetary metal. Historically, silver circulated as currency for centuries. It's segmentable, reachable, and universally known. Retailers are able to gather it. Nations can hoard it quietly. And when trust in fiat systems wavers, other stores of value gain importance rapidly. Now return it to the West. The COMEX framework is based upon trust. It's effective due to the fact that players are confident the majority of agreements will be settled with funds. However, what transpires if distribution stress builds? What transpires if more individuals request actual metal as opposed to rolling agreements? Registered holdings diminish. Paper influence turns out to be obvious. Short rolls feel pressure. And trust, the unseen adhesive keeping the derivative framework intact, commences to break. Here's the circumstance no one depicts openly. Registered supplies drop further. Open interest stays increased. Shanghai markups broaden. Tangible keeps traveling east. Sooner or later, an inconsistency turns out to be obvious. And when that occurs, short squeeze characteristics spark, rapid reevaluation occurrences, intense spikes, spreads broadening beyond historical standards. Not since silver suddenly turned out to be valuable, however, since the impression of wealth collapses. This is not simply a product exchange, it's a geopolitical battleground. East accumulating tangible metal, West exchanging paper, and someplace in between 3.1 million ounces vanish from registered supply at the specific bottom. Now here's the component that truly ought to make you unpleasant. Since this supply stress is not occurring in isolation, it's clashing with something considerably bigger. The worldwide debt framework is cracking simultaneously. Start with the magnitude of it. U.S. national debt over $34 trillion and climbing constantly. Interest cost alone going into the hundreds of billions yearly. Every rate boost magnifies that worry. Japan. Bond instability trembling what was once deemed the most dependable sovereign marketplace on the planet. Yield curve command tried. Intervention murmurs growing stronger. Globally, sovereign debt at record highs. Now connect that to silver. Whenever debt degrees explode, central banks encounter a selection: defend currency balance with strict policy, or safeguard the debt marketplace with liquidity. And traditionally, whenever actual returns decline, meaning inflation runs hotter than bond returns, precious metals rally. Silver does not shift due to news. It shifts whenever buying power wears away. It shifts whenever actual returns turn negative. If central banks rotate, if rate decreases start under economic stress, liquidity returns. And liquidity does not sit in funds, it streams into assets. Here's the snare the Federal Reserve is caught in. Inflation hasn't vanished. It's consistent. Services inflation remains. Energy instability continues to be. Simultaneously, economic downturn pressures rate decreases. Labor markets weaken. Credit spreads broaden. Cut rates. Risk inflation renewal. Do not cut. Risk debt instability. That's the printing snare. Whenever push comes to shove, history informs you what transpires. Liquidity triumphs, currency weakens, hard assets profit. Now layer in endemic fragility. We've already witnessed financial industry stress episodes in recent times. Liquidity situations, emergency amenities, confidence shocks, depositors discovering that completely reserved is not constantly what it appears like. Confidence in financial intermediaries is no longer unseen. And silver, unlike a bank deposit, does not rely upon another person's balance sheet. Now circle back to the 3.1 million ounces. If that was actual accumulation, if that was a calculated tangible grab at $78, then every $10 shift greater equates to approximately $31 million in incremental gain on that posture. Silver to 88, $31 million. Silver to 98, $62 million. That's how size intensifies. And here's where it turns out to be fascinating. If silver clears key resistance degrees, psychological round figures, momentum investors pile in, short rolls get unpleasant, volatility broadens, and in a leveraged derivatives marketplace like COMEX, short covering can transform orderly rallies into vertical spikes. We've witnessed it previously. Thin liquidity pockets, rapid reevaluation, stops cascading upward as opposed to descending. However, do not get intoxicated on hopium. Silver is unstable. Historically also in bull styles, it retraces 10 to 15% intensely. It shakes out weak hands. It penalizes influence. That's how the marketplace washes itself. Leverage eliminates the impatient. And that's where the majority of retail investors get caught. They chase the breakout. They overextend. They get sold off on the initial pullback. Meanwhile, the player who accumulated tangible metal at the bottom does not care about a 12% swing, because they're not exchanging ticks. They're setting for structural shifts. Here's the further snare. Paper markets create the impression of wealth. You can press a switch and acquire exposure. You can exchange agreements worth thousands of ounces with minimal margin. It feels liquid. It feels deep. It feels unlimited. However, tangible markets expose deficiency. Registered supplies decline. Delivery notices climb. Markups broaden. And all of a sudden, the difference between exposure and ownership is important. So understand custody risk. If you hold futures, you hold agreements. If you hold ETFs like iShares Silver Trust, you hold shares representing exposure. If you hold tangible metal, you eliminate counterparty exposure totally. No clearinghouse, no authorized participant, no redemption gateway, just metal. And in a world drowning in sovereign debt, derivative influence, and central bank intervention, that difference turns out to be everything. Because when the debt framework strains, whenever actual returns compress, when liquidity floods back in, when confidence flickers, assets that cannot be printed turn out to be re-evaluated. 3.1 million ounces at the specific bottom may resemble a lucky exchange today. However, should the large-scale clash escalate with amplified debt strain, monetary anxieties, and delivery bottlenecks, it might be looked back upon as a shift spanning generations, moving from transient owners to steadfast holders. And should the framework ultimately falter, as derivatives come undone and debt arithmetic ceases to compute, those in possession of notional guarantees will come to understand the disparity between market price and intrinsic worth. Presuming this was truly a $240 million seizing of the lowest price point, just as reserves diminish and debt balloons, then what we're observing isn't just a surge, it's a relocation of affluence. Thus, let me know, are you safeguarding notional guarantees or tangible possessions when the framework stumbles? Share your viewpoint below, and to gain early access to the upcoming analysis before it becomes widely known, ensure you're subscribed.